Hello, welcome to another video from stageanalysis.net. Let's do a quick update this weekend. We've had some changes in the market, so I thought it was worth doing a video this weekend. So let's begin by looking at the S&P 500. I noted on my Twitter account on Friday that we were set for, there was a chance we would get a bearish engulfing candle again, like we saw the reverse of this when we saw the market bottom, where we saw a bullish engulfing candle where you have a obviously lower open and a higher close, and obviously the bearish engulfing candle was the opposite of this, where we had a higher open here and we were looking to see if it would get a lower close than the previous week's open, but we didn't get that. We did get a little rally at the end of the day on Friday, so it managed to hold the 30-week moving average and previous support and closed down it still closed down quite significantly on the week low, down almost 5% for the week in the S&P 500. Other indexes got hit as well, across the board really. Nasdaq, if we look at the Nasdaq, it was the strongest again. It had a very strong start to the week where we pushed to new all-time highs, and we actually touched the 10,000 level before reversing back again. Obviously Thursday was an extreme day in the market with a gap down and then just continuous selling throughout the day. Very, very orderly selling though. There wasn't any panic in it. And then Friday we continued a little bit, and then we had a gap open up in the morning when we sold back down again. Then it was a choppy day, but it was a very weak looking rally in my opinion, so it gave me some pause, especially with the shape of the weekly candles that we've seen across multiple charts. I mean, obviously lots of the CanSlim investors only look at the Nasdaq really, so it didn't look quite so bad for those kind of trades, but 80-90% of the market looked more like the S&P and the NYSE down here, where obviously we're having huge reversals of the week before. So yeah, looks like could be in a pullback phase. Whether we go any further, we don't know. You might just go sideways, but we will see. The NYSE reversed back below its declining 30-week moving average still, so remains in. We'll give it a tentative stage 1A. It might still be in stage 4. Same with the small caps, with obviously the close above the declining 30-week moving average the week before gets a tentative early stage 1, but the obviously sharp reversal back below again. We could still be in stage 4. We're not. It's not sure really. Nasdaq obviously with the breakout to new highs pushed to stage 2 for the first time, but obviously the reversal back down below the high again, so failed breakout there. So we're still in stage 1 territory in the Nasdaq as well, and the S&P 500 with the close above the 30-week moving average there. But obviously strong reversal back, with obviously potentially still in a very early stage 1 in the S&P 500 as well. Let's move on to the next. So next we've got some of the commodities charts and the Treasuries. So the 7 to 10 year Treasury bond, we had a sharp reversal the week before, breaking down from this tight consolidation phase that it's been in for a while, but we reversed back up this week strongly, closing back near the previous week's open. We did actually make a slightly new high above the week before, but it fell back down obviously as it does the opposite pretty much to what stocks do. So we remain in a stage 2 consolidation range near the highs on that. Gold looking very similar. We had a shakeout move the week before where we pushed down below support, but actually shook me out of my longer term position. So I got out of my longer term position at around break even that I've been using for a hedge for a while, but we had a strong reversal this week, so obviously unclear where this one's going still, but remains in stage 2 in a consolidation phase near its highs. Oil, on the other hand, it's still below a declining 30-week moving average. It's had a obviously massive run off the bottom in its stage 4 bounce, but it reversed back this week, dropping 8% and closed back near the lows of the previous week. So this one is still in stage 4. We could obviously see some consolidation or a move back down here. And copper, obviously 2 weeks now above the declining 30-week moving average and back above support from its previous stage 4 breakdown. So this one is currently in stage 1A, so looking better in some ways, but obviously stage 1A is still very early in the obviously basing phase, so we could see a lot more chop and back and forth, so, or it could even fall back into stage 4 again, but at the moment it's in the early part of stage 1. Okay, next up we've got the percentage of stocks above the 150-day moving average, which is the medium-term moving average for the sectors. So I track this myself each week, and basically we had some excessive moves in some of the sectors. We had basic materials lost a quarter of the stocks, fell back below their 150-day moving average again, as did industrials. Almost 26% stocks fell back below the 150-day moving average after breaking above it last week. So yeah, it was a big move down across the board really. What had the strongest week? So energy was actually the strongest week. What else? Healthcare, but yeah, everything had a terrible week. So let's have a look at the visual chart of this. So on the visual chart you can see all of the sectors we had previously. In the previous week we had 3 sectors push up into the bull range. We had a few pop up above the 60-70% range. I think it was technology, healthcare and basic materials were up in the bullish range, so we're in the stage, what I consider the stage 2 zone. Neutral plus is stage 1, stage 3 zone, so they've all fallen back into this range again now. So with obviously about what we got there, 6 sectors falling in the bearish range again, down in the lower range. So everything's in stages 1, 3 and 4 again, nothing in stage 2 currently. Next we've got the NYSE Bullish Percent Index and the Nasdaq Composite Bullish Percent Indexes. Wanted to highlight the P&F charts of these, as they are what are considered the head coach of the market breadth tools. They basically give excellent long-term and medium-term signals, and obviously when they're breaking out from one of the extremes. So as you can see, obviously if you go back down to when it reaches the extremes and then comes up, you would have had this is March number 3, you would have had a bull alert here, and then pull back into here in April number 4 there, and then the breakout above here at 54. So early April this gave you a strong buy signal, and would have gave you an potential early buy signal down in March time there, and same on the Nasdaq. But at the moment we've got the opposite happening. So if you go to investorsintelligence.com/breadth indicators HTML, you can get the definitions of how the P&F statuses are calculated. So at the moment we've got the bull top status on the NYSE, and we've got a bear alert on the Nasdaq. So the bull top happens when you're above in the upper zone and you reverse to a column of O's and you're still above the 70% level. So if we break through the 70% level, it would change to bear alert, but at the moment we're still above the 70% level there. The Nasdaq, we moved above the 70% level, but we reversed back below it. So this is a bear alert signal, as it hasn't yet given a double bottom breakdown signal or moved so back through the previous column of O's. So this is on a bear alert and this is on a bull top. And if we look at the line chart versions of these, you can see that more clearly. For those that don't understand P&F, obviously we're in the upper high risk zone in the NYSE, and we popped up into the high risk zone on the Nasdaq, and we've pulled back below now. So yeah, we're getting some caution signals in the bullish percent indexes. The NYSE percentage of stocks above their 200-day moving averages has fallen back below the key 30% level, but that does, although obviously that looks negative short term, that actually now gives us a clear breakout level for when this actually turns back above here, so which would give you obviously a proper proper breakout signal. So if we swing, however long it takes to swing back down and back around again, the break above this level here, when it moves back through the 30% level and makes a double top breakout on this, will be a strong buy signal. So we'll be looking out for that. And the same on the 150-day, the midterm here, it's a bit higher, closer to the 50% level there. But this, hopefully this will take off in the short term. We're obviously still in extreme oversold levels up here, so obviously this, hopefully the pullback will help this alleviate a little bit, and we'll get back down into the middle range again, where we can obviously have a much better percentage chance of making some gains. So obviously it's not a great idea to be doing a lot of buying when it's up in the upper echelons here in the high risk zone. Obviously you want all three of these breaking out from the lower zone. So as you can see, in April we had strong breakout from the lower zone in the 50-day. We didn't get that breakout until mid-May in the longer term in the NYSE, but in the Nasdaq you did get all three of them break out by the later part of April. So gave you the entire month of May and a couple of weeks into June to obviously make some strong gains. So you would have gave you a much better we had a much better signal on the Nasdaq, but obviously then NYSE one was the longer term, didn't move up until later. So until we were extremely oversold on the short term. So that gives you an idea of why you want all three moving together and not to be oversold by the time you actually get that signal. So yeah, let's moving on. So I do my own combined chart of the 50-day, the 150-day and the 200-day MAs of the Nasdaq and the NYSE. So each one of these charts here, so 1, 2, 3, 4, 5, 6, all of these charts, I combine all of these figures into one chart, which is this chart. So, and because that, obviously you can get short-term oversold, and obviously the long terms can still be in the lower zone, like we saw in the NYSE chart on the previous page. So you can see, like, obviously we're short-term oversold, but we're still in the lower zones on these. But obviously the combined data gives us a clearer picture of where we actually are overall. So I've highlighted here the zones. So basically up to 40% is the lower zone, when obviously you're in the stage 4. When you're in the middle zone here between 40 and 60%, it's a stage 1, stage 3 zone, and when you're above 60% you get into the stage 2 zone, where obviously when you're in a bull market sort of phase. So we did have a pop above last week, which I highlighted this on my Twitter account, I believe, and basically we were moving into the upper zone here, but we've pulled back down strongly this week and we're back in the mid-range, so literally completely neutral, just above 50% here. If we look at the longer 20-year version of this chart, you can see that basically back in April 2003 we made a break like last week, where you'd moved from the low and you'd got back above the 60% level, and in May 2009, however, they immediately continued on into the upper zone and got well above 70% and stayed around those levels for a while. The May one it got up into the 70%, so it did have a pullback about a month or so later, but like initially it didn't pull all the way back like we've got here. So we've actually pulled back much further here. So it's not clear whether obviously I've seen some people saying that we're obviously using these days and comparing where we're at the moment to these kind of periods, but obviously the data for this doesn't yet support that. It's still sort of in between. Like we had some lower zone pops and moves to the mid-range and then pull down again lowers, and in 2008 you had that, in 2002 you had that, in 2015 you had that, in 2011 you had that. So at the moment obviously volatility is still extreme, so this could be a little bit more distorted. We could still be in these sort of periods where it could still have another lower low and we could still go further down, or we could be moving into these periods. It's still, we're in a mid-range, so it's unclear. But basically to get really bullish, we want to see this up in this upper zone above the 60% level and holding above that for weeks and months, not pulling back immediately from it back into the mid-range again. So this just highlights that we're still in a stage 1 sort of phase, and we're now in a basing phase. Even though the chart's made a huge V shape, like there's a lot of chance, there's still a lot of volatility, and obviously we're going to need to do a lot of base building until we get some serious breakouts across the board. We obviously, leading stocks will break out earlier, but in order to get obviously the entire market running again, we need to see this have sustained move back above the 60% level and holding in the upper areas. So as you can see from these 2003 period and the 2009 period, we got well above 70% and held there for a while. So we're not there yet, so we're still in a obviously mid-range, so we'll see. We'll check back on this in a while. Okay, next up we've got the NYSE advanced decline issues. This has improved significantly the last few weeks. We made a new high. We've pulled back in a bit, but we obviously, for the majority of previous videos I've been doing, we were in this sort of choppy range, and we were struggling to get back above the 50-day moving average there. The 50-day moving average has turned up. We're well above it. We made a new high and we've pulled back in a bit. So this is bullish, and we're now in a little pullback here. NYSE has been McClellan Summation Index has been bullish for a while. We had a few little bearish thrusts down back below the 0 line, and we had another one this week, so we're back in a neutral zone. We could potentially break down again here, so that one's one to keep an eye on. The Summation Index itself has turned a little bit at the top here, but we still remain above the short-term moving average there. I think that's a 10-day moving average, so obviously if we turn back below that would turn bearish, but at the moment that remains bullish. Well, the other one remains, the oscillator remains more neutral, but watch for a break below here. We'd obviously get a bit more bearish. The short-term momentum index, we made new highs, which is a good sign. We had a sort of breadth thrust, so obviously that's good for a longer term look, but we've pulled back a bit here, so it's still looking stronger than it did when I did the video a few weeks back. So this is like neutral to stronger. The actual momentum index, which obviously is from Stan Weinstein's book, which is the 200-day moving average of the NYSE advanced decline line, we're still churning below the breakdown level that we saw in February. We have broken above this declining trend line, which shows some short-term strength, and this consolidation range that we were in down here, but we're still below this sort of range where we broke down. So the Nasdaq, which I'm not showing actually, has actually broken above this level a little while ago. So the Nasdaq obviously has been stronger the entire time, but the NYSE, obviously we're looking for a broad market participation in order to get back to an actual bull market across the board, not just in the Nasdaq leading stocks. So we want to see this get above this area and start trending higher again, but it is a better look. We've got the 10 and 30-day EMAs of the advanced decline line. This NYSE advanced decline line has been on buy signal since late April there, so obviously that would have kept you in if you follow that. I like that one quite a lot. I use that quite a lot for signals. I think it's an excellent tool, so it works really well. But obviously none of these breadth oscillators breadth indicators work in isolation. The whole point is to use them as a weight of evidence approach. So obviously why we show grouped charts of all of these, so because obviously some are bullish, some are bearish, some are neutral, so it's getting a picture from all of them and what they're doing, and sort of gauging what the overall weight of evidence is from all of the indicators at once. So as you can see, we've got a neutral, slightly bullish stance still on the advanced decline issues, but there are some warning signals in there. Next up, we've got the new high, new lows. Again, this continues to be tepid across the entire market. We have on the cumulative line broken above our 50-day moving average, which has started to turn up for the first time. As you can see, we still remain a long way below like the original highs, but as you can see from the 2018-2019, that doesn't necessarily mean anything particularly. It's more about the crossover and start to trend higher, because obviously if you'd got in 2019 around these periods, you would have done very well, and it kept you in the entire time and got you out again, obviously early March-ish time there. So basically, in terms of actual trend following, it's the cumulative US new highs, new lows is excellent for keeping you in and stopping you from getting out too early during shakeouts. So if we look down at the individual charts, you've got the NYSE and the Nasdaq on the bottom here. So the NYSE still hasn't had a single day where it's broken above the signal line, which is 100 new highs since the February breakdown there. So look, literally since that February 20, early February 20th time, it was above the 100 every day, and it hasn't managed to get back above that. We had seen a slight pop in the last few weeks, and it's pulled back again now. Nasdaq, on the other hand, we've had multiple days where it's broke above the 100-day signal line, but as you can see from the November, December, sort of January time period, you want to see this breaking above strongly every day and holding above there every single day. Should be hundreds of new highs, not the tepid amounts that we're seeing currently, and we're back down to 24 on Friday there. So new high, new lows, some positives. The cumulative line there, we remain obviously we're not breaking down below the zero line there currently. We remain on 533 at the moment, but still very neutral and very weak. So neutral with some slight positives, but if it starts breaking below the zero line, the cumulative one here again, then yeah, that'll be a very negative sign. So keep an eye on that one. Okay, next up, we looked at this a few weeks back. I just wanted to highlight this one again. Obviously, after this week's volatility, we've got the NYSE percentage of stocks above their 50-day moving average minus the NYSE percentage of stocks above their 200-day moving average. Because obviously, there's been a huge disparity between these the last few weeks and months, basically, where the short term has got really extended and got up into, we had NYSE percentage of stocks well above 90% level in their 50-day, but the 200 days were still below 30%, and so we had a big range with a 60% disparity at one point. And as you can see from these previous periods, we showed obviously when it got above these levels what happened next type thing. So let's revisit those charts. So next, so the first one, this 2002 period here where it got above, we can see that when it got to that level and started declining, we had a 15-week decline with some obviously reversals, choppy action, but we did have a 17.5% decline there. Next, what have we got? We got 2009. So if we look at the 2009 peaks, we had two peaks in 2009. So if we go back to that one, and from the peak in 2009, we had a 9-week decline. We had a small break above, and then we declined another 29% basically over that period. So drawdown of 29%, and then the second peak, we only had a drawdown of just over 3% before we started moving up again. So the next one is in 2011, and in 2011 from the peak, you can see we had a 5-week drawdown. We had a just over 10% drawdown. Similar look to what we're seeing this week actually on R1, where we had a strong reversal week here. Obviously our peak on our current chart was the week before, I believe. I'll show you that in a second. But then we had so you can see that obviously it had a reversal week and then followed down again before actually starting the bull run. So we could be, this sort of highlights that we could be for instance choppy trade, and there could be a bigger drawdown at the moment. So where are we currently by comparison? So by comparison, we broke out higher initially, but from the higher peak, but this has gone lower. So we now reversed back below the peak, and we've had a drawdown of almost 3% currently. So that's the smallest drawdown of all of them, and the smallest amount of weeks of all of those previous examples. So if we go back through them again, so we had 5 weeks, we had 9 weeks, we had 15 weeks. So from these peaks, so you can see we are still at extreme levels here. So if this starts pulling back down here, we'll see how it plays out. But currently we've only had a 3% drawdown from the peak, so the worst case scenario was a further 27% from here, and the best case scenario was that we'd already finished and we moved higher and went on to new highs. So we'll see how that continues to play out, but I think it's an interesting one. Okay, to finish off today, we're going to look at the VIX. Not something I look at very often, but I think this week's spike took us back above the 10-week moving average again. As you can see, since the April follow-through day, we've been below the 10-week moving average, and we did move below the 30-week moving average for a week, but we've strongly moved back above that again. As you can see, historically, you got the 2009, we had the similar sort of bounce. It got back above the 10-week there and then carried on back below again. We've got any other periods where it's similar. You got 1991, sort of 1990 there. It spiked back above quick briefly, moved back below, but obviously from these sort of levels, we're at rare levels, but obviously a spike back above, whenever it's above the 10-week moving average, we're in a bearish zone. So until this gets back below that again, like this remains on a bearish signal. But as you can see from, if you look down in the lower bit, the VIX compared to the S&P 500, obviously when it gets during bullish phases, we generally are below this moving average here. So as you can see from the close up, we've bounced off of that moving average there, which is the 52-week, and obviously we need to get back below this area here to get into a true bullish phase. As all the key bullish phase, you look from 2003 all the way through to 2007, you had a few brief spikes above it, but the majority of the action occurred below. So we want to see this getting below here, which we haven't been below yet since the February breakdown. So at the moment we're still, as we said on the initial charts, we go back to the initial charts, we're still in a sort of stage 1 range. Like, we could still be in stage 4. It's obviously, there's many markets that haven't made it back to stage 1, but obviously when you break above the 30-week moving average, you give it a tentative stage 1 rating. So we are, and obviously the Nasdaq did break above there, so we've got a tentative stage 2 and we've pulled back. So the Nasdaq could, in theory, be considered stage 2 still, because it hasn't broken, hasn't broken any key stop losses or anything like that yet. So, but personally, I still have it in a stage 1, because obviously the stage 2 breakout failed. So we will see. But yeah, until next time, thanks for watching, and please like and subscribe to the videos, and yeah, come and visit us at stageanalysis.net if you like what I do, and yeah, and follow me on Twitter at stageanalysis, and I'll see you on the next one.